Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. For many first-time buyers, getting onto the property ladder can feel overwhelming. Higher property prices, affordability pressures, deposits, stress testing, and constant headlines about rates and the housing market. And because of that, a lot of people assume that home ownership is simply out of reach. But what we're actually seeing in the market right now is lenders becoming more innovative. New products, more flexible affordability solutions, family-assisted options, and alternative routes to home ownership are opening up opportunities that many buyers didn't even realize exist. In this episode, we're going to break down some of the options currently available to first-time buyers, how these products work, what buyers should be thinking about before taking their first step. So in today's episode, we're going to do something a little bit different. We mainly focus on the investor market and just helping developers and investors and landlords understand and navigate all the different items going on in the market. But an important part of the property market and for its movement is first-time buyers and the residential market, because that feeds into movement everywhere else. And obviously there's been some news. Obviously, the interest rate news about things that are going on in the Middle East, there's a bit of scaremongering. There's also the chance of more inflation, which will put more pressure on people. And so there's been some news. Lenders are starting to innovate a little bit, and just thought we'd touch base on some of those changes to help. As whilst we have investors, they may be selling some of their properties and those may be going to first-time buyers, which maybe will help that conversation and allow their tenants more information on what is available to them. Or also they might just have friends or family or children that might be interested in buying their first home. So let's jump into it and let's break it down for you. So why do first-time buyers feel stuck at the moment? So the main reason first-time buyers, the age for first-time buyers is getting older and older all the time. And the biggest number one reason for that is deposit challenges. So the ability to save a deposit whilst renting and the cost of living increases has been really, really difficult. And the increase in the bank of mum and dad providing that earlier inheritance or gifts towards their first purchases has been huge over the last few years. And that's going to continue. There has been a steadying off of that. Mums and dads are starting to become a little bit more pressured themselves and therefore are struggling to make as many deposit gifts as they have been over the last few years. So that's something interesting to keep an eye on. And maybe one of the reasons why some of these lenders have made some shifts with low deposit options. Affordability is also an issue for first-time buyers. Like I said, the stress testing on income multiples and various other things, outgoings. Obviously, rent versus mortgage frustrations, how difficult it is to save for a deposit, but also the cost of a mortgage versus renting. In some areas, it's actually cheaper to get a mortgage than it is to rent, whereas in other areas, it's not. So depending on where that is. Wage growth versus house prices. House prices are continuing to rise, even if they have slowed off a little bit. And wages have increased as well, but it's just making sure that they don't always align. And that makes a challenge for first-time buyers all the time. And then just information overload, not knowing where to start. There's so much information available and a lot of it is conflicting. So that's the purpose of this podcast, to try and break that down and make things easier. So one of the biggest challenges for buyers is not actually the motivation, because in the UK, the motivation is to buy your first home is still strong. It's actually believing that it is possible. And a lot of people don't even look because they just think it's out of their reach. And this is part of the news that some of the products available these days is what I'm going to share with you is to understand what that looks like. So what's been changing in the market recently? Lenders are becoming more flexible. They're becoming more creative. and ultimately they're becoming more competitive. And when there's more competition in the market, that's a good thing from a borrower's perspective, because more options, they can't compete necessarily on price, because you can only go so low from a pricing perspective. But what that means is then they become a little bit more flexible on their criteria and the options that they provide. So that's where it's starting to become a bit more competitive, which is great for buyers. Like you said, the affordability is starting to be loosened up. The deposit amount is reducing, and therefore, and the increase in options for family support. So the market is changing, and there are lots of options for first-time buyers now. So one of the things that we're seeing is lower deposit mortgages. There's lots of options with a 5% deposit. And news has come out recently that Lloyds Bank have now instigated this, not a 5% deposit, but a £5,000 deposit on a property purchase of up to 300,000. Now, this seems excellent, and it helps people get on the property matters. So if you've got £5,000, basically you can buy a property. It's not obviously that simple, depending on the rest of the criteria. However, it just opens the door to way more people. Now, yes, we're looking at the risks that we went through back in 2006, 2005, 6, 7, when the last housing crash was due to Northern Rock were taken over by Virgin. Northern Rock were lending up to 125%. So they would give you 100% mortgage, and then they would give you up to 20 or 25% of the value of the property on top to do home improvements. So you'd have on a 100 grand purchase, you could borrow 125 grand, and then the crash came, and that house was then only worth 80 grand. And that left people in a very difficult position. So it's not something you want to dive into necessarily with the higher loan to value. So go into it with eyes wide open, but it does mean there's a lower barrier to entry into the housing market. It can mean higher monthly payments and higher rates, but for the right people, it is a great option. Now, the news that Lloyds have brought this out isn't massive news. I've shared on this podcast in the past that Accord Mortgages, which is part of Yorkshire Building Society, have had this in place for quite a while. And actually, theirs is probably slightly better, because they've got a 5k deposit up to 500k purchase price. So actually, that's open to more people in different parts of the country. So that's good. The other thing that's loosened up within the low deposits, not so much the low deposits, the other thing that's loosened up a lot is around affordability. We'll touch on that a bit. So, for instance, NatWest have just released the fact that if you've got a 25% deposit, which obviously is a much bigger deposit, they will lend 6.5 times joint income if your joint income is over 150,000. Now, again, this will only feed a certain part of the market, but it just goes to show that the lenders are becoming a bit more competitive and a bit more flexible on that. And again, this isn't necessarily new. HSBC have been doing 6.5 times income for Premier customers for a while. And then also there are other lenders that will do sort of 5 to 5.5 times joint income multiples as standard. And so there are with no loan to value cap. So, there are lots of different options, and if you look online, you'll probably still see that the 4 times income is your affordability. And yes, that is a general rule of thumb that's been in the market, but that has changed significantly. In some instances, it might only be 3.5 based on your circumstances. But like you said, there are other circumstances where you could get 6.5 times your income. So there's a lot of people out there who maybe aren't aware of this, who could get onto the market, onto the property ladder. There's still plenty of options for family assisted and joint borrower sole proprietor. This is great where your parents are able to help. So this is parents or family support. Family can support with an income to support the mortgage under a joint borrower sole proprietor without owning the property. So that helps affordability in an opportunity where if you've got a career path where there's clear growth in your income, that's a great stepping stone. So you can't afford it now, but you'll be able to afford it in the future. Maybe you're a junior doctor or a junior accountant, or starting on a low salary, but that will grow. Then your parents could help you. But it's not just professionals. This can help with various other occupations. Also, with the family assisted, they could take out a charge or a mortgage on their property to fund the deposit on your property. So that's another slant on how that could work. So if you've got family members with equity in their property, grandparents, parents, etc., then they could release some of that to feed into your house purchase. There's various options around shared ownership. So again, this is more housing association stock where you buy a share of the property. It's a lower deposit and a smaller mortgage. And then there's a combination between rent and a mortgage. And then in the future, you can have something called staircasing where you can remortgage to buy further shares in that property. And these are generally new build properties as well. So usually brand new properties in good condition. So these are great opportunities, especially in more expensive parts of the country, but just making sure you understand the different criteria and the conditions within those. Developer incentive schemes, where again, these are new builds, and property developers will have certain schemes available where they will contribute some towards the deposit. They will have schemes where they might pay the stamp duty. They'll fund the interior of the property. They might put in the carpets. They might fit it out for you, put beds and everything in there, so you haven't got to do that. There's various schemes available through new build developments. So if you are considering this and haven't given it some thought, then have a look to see what new developments are going on in your location, and visit those sites and see what incentives that they do have. So the things to really focus on as a buyer is, around mindset. It's not just about what is your maximum borrowing. It's what is sustainable, because yes, you could get 6.5 times income, or you could just buy a property with a $5,000 deposit, but you need to understand is this sustainable over the longer term? What happens if rates go up? Future affordability, if you haven't got children now and you do, and one of you's off work, how is that going to impact your lifestyle? Is it going to, if you've got a job that you need to move around, how is that going to give you any flexibility? And one of the benefits that younger people now are enjoying about renting and overbuying is that flexibility to move and travel and change cities and move around for work. So you just got to make sure it's the right thing for you at that time. Getting onto the property ladder is important, but staying financially comfortable is also really important. So just making sure of that. And then some common mistakes that first-time buyers make, looking at the headline rate only. It's not just necessarily about the cheapest rate, because the cheapest rate doesn't always mean the best deal for you overall. What other fees are involved in it? Overstretching yourself, I've mentioned already. Leaving advice too late in the process. So you might get involved and tie yourself into something that you shouldn't have. And we do see this from time to time. People taking out long-term fixed rates when actually the best thing for them to do was go for a 2-year, because certain things were on of their goals, and the next 5-year plan for them was to stay in this city and then move to another city, and that's caused them problems then with early repayment charges. So just understanding your circumstances, your goals, and your next 5-10-year plan. And also just assuming that online calculators are accurate. These calculations change almost on a daily basis based on criteria, rates, etc. So yes, they're good as a starting point, but once you've got to the point where you're ready to move forward, you want to get some advice around your individual circumstances. And then how brokers add value. Obviously, we think we add value, and we do, because we get feedback on that all the time. You could go to your bank, and you can do, but banking isn't like it was in the past. There's no relationship with your bank, and sometimes some banks will offer slight better rates or some reduced fees if you bank with them, but most of that has gone away. It's a very, very competitive market. Products change all the time, criteria changes all the time, and it's all about affordability, and that changes massively between lenders. And there's new products coming out and new, various incentives coming out all the time. So, a broker who's on top of this will be able to search the whole of the market. We've got lots of different tools that we use at our disposal, which means that we can get you the best deal very quickly and saves you a lot of time and hassle from, I know a lot of banks will say, right, you've got to have a 2-hour or 3-hour initial phone call, then you've got to come into branch, but you can't do that for 2 weeks and various bits, and they make it very, very difficult because they're just understaffed. They're not doing it on purpose. They just haven't got the staff that they used to have. They don't have many mortgage advisors anymore. They have mortgage consultants who aren't giving you advice, and it's become not as strong as it used to be within the bank sector. So is it actually getting easier? Well, there is more innovation, there are more flexibility, and there's more competition. More competition can only mean good things from a buyer's perspective, because it gives you more choice. So when you got more choice, you've got the more chance of being able to get onto the ladder. Is it getting easier? Then from an affordability point of view, then not necessarily. Obviously, we've got the cost of living crisis, the conflict in the Middle East, petrol prices are going to go up. That's going to be impacted later on next year, because fertilizer is one of the biggest issues, a shortage of fertilizer, which is going to impact food prices, but not now, because that's going to be in the next cycle. So that's probably going to come into next year. So that's going to impact what we can afford. And, shopping is going to become more expensive. Petrol is going to become more expensive. Just the overall cost of living will go up, and therefore you're going to get squeezed. So is it the right thing to go and max out on your affordability right now? Then possibly not. Just keep an eye on that. And obviously the deposit side of things, we've already touched on. The bigger the deposit you can put down, the lower the rate and the lower the mortgage, and therefore the lower the monthly payment. So there's various things to consider, and it's not just one piece of the pie that you need to consider. So some tips for first-time buyers: obviously speak to a broker early. You may have some issues on your credit report. We can help you understand what those issues are and how you can solve those problems. Some of those are easy fixes, but some of them can take 12 to 24 months to fix. So if you are thinking of buying, you need to look at this sooner rather than later. Understanding what your affordability is like, so how much you could borrow, what those rates, how much of a deposit you would need, and what those rates would look like. Setting realistic expectations on your purchase price. So if you're already looking at a certain value, that may never be achievable to you. Or you could be setting yourself on the lower end when you could actually afford something much more expensive and not even realize, and you've been struggling to find the right property because you don't realize you can afford something a bit higher. And then just focusing on that long-term stability. So the buyers who succeed usually start planning earlier than they think they need to. So hopefully that's been helpful, just capping on some of the things that have been going on in the market recently. And, buying your first home will probably always feel like a big step, because it is. One of the biggest mistakes people make is assuming that there's only one route to get in there. What we're seeing now is a market that's evolving. Lenders are becoming more flexible and more creative in how they support buyers. And again, that's coming from competition. But understanding those options is key. So whether you're ready to buy now, in 6 months from now, or simply trying to understand your position, having the right guidance early can make a huge difference. Thanks for listening, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.